Thank you very much, everybody, for joining this session with RockCreek. I am Caroline Atkinson, Senior Advisor at RockCreek and formerly Head of Policy at Google. And before that, I worked with President Obama in the White House as his Deputy National Security Advisor on international economics. And I'm very glad this morning to have a discussion planned with Henry McVey of KKR and Mohsen Fahmi of PIMCO. And I'm sure that you all know these two very terrific participants, but Henry is the global macro asset allocator for KKR, and Mohsen worries about how PIMCO should be proceeding in these circumstances. I'm going to ask each of them to introduce themselves briefly, and I will now kick it over to Henry and ask him to do a brief introduction of himself, but also the first question, very basic, is the macro outlook improving or is it going to get worse? Henry.
Okay, great. And thanks for having me, everybody, and hope everybody's safe. I'm Henry McVey. I've been at KKR 9 years. I'm a senior partner in the New York office. I run our macro and asset allocation. I'm also CIO of our balance sheet, and then I run our market risk. We try to draw on our 170 portfolio companies globally, as well as doing independent macro research. I would say things are still improving, but the rate of change is slowing. And it also depends on how you look by region. What I would say is the U.S. probably has had a very sharp spike back, but given some of the policies around opening up too early, that's starting to affect buying. And we see very different behavior patterns. Unlike prior cycles, you see people focus on personal safety. Can they get to work in a safe way? It's not just financial safety. Do they want a second home? So there's a lot of different trends that we see here. Europe is, I think, the policy response has actually been pretty strong, particularly given their low organic growth rate and how they've kind of the governments attached themselves with the employer, and you see that in the currency. And then in Asia, we had seen a notable pickup in our business. I would say some of the recent spikes, similar to the U.S., albeit not as strong, are starting to slow the rate of change. So the trajectory is still positive, but the rate of change is slowing.
Right. So you covered a lot of ground there, but let me switch now to Mohsen and just please let us know what's important about your position, and then also are things getting better on a macro sense, macroeconomic outlook, or are they deteriorating?
Well, good morning. Thank you for having me. I'm managing director with PIMCO, and I sit on the investment committee, and I also run all of PIMCO's suite of enhanced equity portfolios called Stocks Plus. I think I generally agree with what Henry said. Things are still getting better at a macro level, big picture level. However, we have seen high frequency data in the US, for example, starting to turn lower. So we are somewhat concerned about the near-term prospects. And one key there is that consumers are really smart, and we've seen consumer behavior change, even in states that have not retightened their procedures, whereby people are less willing to go out to restaurants or spend, and you can see that from credit card data and the like. So we are somewhat concerned that the momentum that we have seen in May and June has started to fizzle down a bit over the summer months. So both individuals and economies adapt, but that's different than saying we can get back to normal. So I think, in the absence of kind of the gold standard of either getting a foolproof vaccine or a very reliable treatment, until you get one or both of those things, you will not go back to normal. However, people will adapt. So we've already seen that compared to 3 or 4 months ago. The science gets better. The fear gets somewhat less. The the impact of shutting down everything has now been recognized as being extremely damaging and so forth. So even if the virus doesn't go away and we don't get a vaccine, don't get a treatment, you will not see a return to the depth of the recession that was, in fact, the shortest ever and the deepest ever that we've ever seen, you know. So people will adapt, but you'll not go back to normal.
How do you see, I think we're all agreed, or you're both agreed, that interest rates are going to remain very low for, you know, for the foreseeable future, certainly for a while, and that will, whether it's driven by the need to finance deficits or financial repression, as you mentioned, or a kind of lack of demand, the secular stagnation argument. So what does that mean for the typical 60-40 defined benefit plans? And what does it mean for equities? You know, somebody was saying to me the other day, look, this is a buy market and everybody is looking for a reason to buy. And that is why when you get a little glimmer of good news about a vaccine or something like that, you get the equities going up. And when you get bad news, they don't go down so much. So how much do you see those sort of technical issues, or maybe they're not technical issues, but anyway, broad trends affecting the equity risk premium and the traditional allocation? I'll go to you first, Mohsen, and then Henry.
Yeah, so it's an important question, not only for your typical kind of generic 60-40, but for its cousin, you know, the somewhat levered risk parity type of portfolio. And both of them rely on the idea that you have negative correlation between stocks and bonds. That is a question that investors will have to debate going forward, and it will really depend on whether the door to negative rates is open or not. Now, why is that? Because if you have a 10-year treasury at 50 basis points, and if you believe it can only go to 0, then that doesn't give you a whole lot of appreciation to shield and cushion your risky asset portfolio, whether it's equities or other types of risky assets. If, however, the door is open to negative rates, then the potential for performance is much larger. Now, one cannot rule out negative rates. However, there are many reasons not to expect them in the near term. Think about the next year or two. Partly because it's such a significant decision that it will require a lot of deliberation and study on the part of the Fed before they approach that. Partly because, as I mentioned earlier, there are lots of degrees of freedom that they can do within their existing mandate and with their existing tools. Partly because even if they exhaust the existing tools, for example, introducing yield curve control, forward guidance, and so forth, and they still feel they need to do more, there are certain measures that they need to put in place. For example, making sure the money market business can deal with it, deciding what to do with bank or individual holdings of cash, what's happening with digital currencies, and so on. So we don't think that over the next 2 years, you know, that we're going to see negative rates. Therefore, the ability of the treasury market to shield a risky asset portfolio is going to be limited, and investors will have to look for other options. Now, there are other ways to diversify. For example, the fixed income market globally is much, much bigger than just simply thinking about treasuries or bonds or gilts. And in fact, the disruption that resulted from the pandemic has created tremendous opportunities in many parts of the fixed income markets. And there, kind of doing your homework is so important. So even in somewhat obscure sectors, such as lending against aircraft, for example. Well, all planes are not created equal. There might be disruption in business travel. Companies that have fleets targeted towards business travelers may have much tougher time dealing with it compared to companies that have different types of fleets targeted towards individual consumers and so forth. So doing your homework in the fixed income space is important. Tremendous opportunities there. And I think what investors will do is they will move away from a very simplistic, high-level 60-40 type of portfolio into a more nuanced portfolio where they might look at parts of the fixed income market. They might look at hybrid instruments like convertibles. They might definitely go towards private credit, private equity, some types of alternatives. And then finally, answering your question about the equity risk premium, I think the major issue there is if investors decide that the treasury market is not going to give them the hedge that they need, then almost by definition, an asset that cannot be hedged needs to cheapen up. In other words, the equity risk premium may need to rise simply because of the lack of a hedging instrument, rather than saying it needs to widen because of increased uncertainty about the future or because economic growth will be subpar, etc. It really has to do with portfolio construction and how to put things together.
That's very interesting. Thanks. So, Henry, what's your reaction on that? And maybe you can also comment. I know you've had views about real estate and also gold, you know, which is having a moment, let's say.
Yeah. So, I think this is a fascinating topic. I mean, if you look at the last 5 years, the 60-40 portfolio returned about 8.5%, which is pretty startlingly strong. Going forward, I agree with Mohsen. I don't think the Fed wants to go to negative interest rates. So I think if you think about what was the role of fixed income or sovereign debt, it was to create a diversifier and create income. And it's harder for it to play its traditional role. So we have been talking about gold in our written pieces that it was going to have to do well, because ultimately people want something in their portfolio when the capital market sees up that actually appreciates or serves as a shock absorber. So they're going to find things like gold. I've thought about, could you buy a equity dividend yield and then have it, wrapped by volatility? I mean, there are things we're going to have that create some buffer. That's kind of point one. Point two is we're going to have to create more yield in the portfolio. We're very focused on, as a firm, I don't know whether we're ultimately going to have inflation or deflation, but I know yield's going to matter. And so the way we're hedging it is we're doing asset-based yield. And so we've been much more aggressive around things like optical and infrastructure. We've been doing some things around housing. If you look at yield curve control in the 50s, that did really well, kind of asset-based lending like that, and then certain parts of real estate. So that's a real focus for the firm and for our clients. On the equity side, it gets tougher because what the index is, this is where I'm probably very constructive on obviously what we do, but on the public markets, more active management, because you're back to a point right now where the top 5 companies have the same market cap as the bottom 310 in the S&P. And so that's how it felt to me when I covered Citigroup and JP Morgan and all those in 2000, and they were the masters of the universe. And then ultimately you had regulation and people realized that they had overheated the companies and there were problems. The law of large numbers will get you one way, and we're probably going to get towards that at some point. So I think kind of finding more alpha sets makes sense. For us in private equity outside the U.S., think about Europe as a proxy. Europe only has about 5% of its public markets in technology. That's about 20 to 25% of our portfolio. So we're trying to create sectorial arbitrages. Same thing. I mentioned Indonesia earlier. Indonesia has 0 technology in its public markets. This is a booming population where GDP per capita is rising. If you're buying the public market index, you're getting along multinationals and banks. That's not going to generate the returns that are necessary in a low rate environment. So I guess the final point is people are going to have to be creative. I feel like the endowment community is out in front of this. I think that the bottom line is people are going to have to take a little more risk, not less risk. But ultimately, on the risk management point, the number one thing that when I study our data from 2008 and 2009, it's to get the themes right and to keep your losses down. The impact of being wrong and what it does for compounding, I'm stating the obvious, is massive. And if you're in a lower return world, having better portfolio construction where you're not making a red-black bet or being able to keep your loss rate down 5 to 10%, it's real money. And so that's the, we're in this, we're going to be picking up pennies in front of the steamroller, and you have to take that mindset, and the underwriting has to be better. And so not everything has to be a, shot to the moon, but the negative impact for being wrong, the cost of that has gone up, and that's by manager and it's by asset class. So, I'm certainly encouraging, the investment committees I sit on and where I operate, and we're trying to meet more regularly, trying to think more strategically, and trying to think that this is a regime change. And the wild card that I don't think we know about, was referenced earlier, is on the dollar. Remember, in public emerging markets, about a third of your returns come from the currency. So if we've been in a dollar bull market. So there's some big things at play here, and I don't profess to have all the answers, but we've tried to create a framework where we're moving ahead and making sure that we reduce the number of outliers where we can get pinched.
That's very interesting. No, thanks very much. And I just want each of you maybe to give some final thoughts. We just have a few minutes left, and maybe I'll just pitch in mine, which is that I do think we need to get the virus under control in order to kind of know where we are. So maybe we're in a COVID world now. We're not in a post-COVID world, and we may not get to that for quite a while. And I totally agree with Henry that in the United States, what's really important is taking care of people's education. And I think we've seen in this experience some of the weaknesses of not having, it's the flip side of the strength of American individuality and creativity and innovation, but we've seen some of the weaknesses of not having a better safety net, and quite frankly, not having enough infrastructure. So I really think the infrastructure is a little bit out of fashion right now. Some people think that it's too slow working for fiscal. I do think that's going to be really important. Building back better, building for a better normal, and not forgetting climate as well as the other systemic inequalities. So anyway, I'd like to go to Mohsen, then to Henry, just for any final thoughts, which can be big, small, in the middle, whatever.
Okay, thank you. So to state the obvious, when people talk about macro, they tend to think about growth and inflation and so forth, and forecasting and what have you. But what they tend to forget is that policy and politics do really matter. And yes. I think, Q2 of this year was a perfect example of that. If you got too pessimistic and too worried about a terrible growth outlook, you forgot that there is a policy response. And so it's very important to bring in policy and politics into this, and this will continue with us even after the pandemic. I think lesson number 2 is a idea that, you need to be optimistic over the long run, because, human ingenuity and creativity is very important, and don't bet against them. And you can already see that in the level of collaboration globally to rush to develop a vaccine
on the science.
Never been done before. And so don't bet against, creativity and ingenuity and progress that will happen. Third thing would be not to forget about the secular trends, especially the ones that you cannot change or fight. There's nothing you can do about demographics, for example. It's just a ticking time bomb. We all know about that. So don't fight secular trends that cannot be changed, because it does affect your investments. And then finally, I agree with what Henry said, asset allocation, robust portfolio construction, and active management is helpful, because that takes a raw material that may be somewhat unappealing and try to change it into something more appealing. And I think this is definitely a time to do that, simply because the raw material is not what it used to be. You don't have double-digit treasuries. You don't have 5% treasuries. You have 0.5% 10-year treasury. So that's an unappealing raw material, and you need to take it and see the implications and change it into something that can help you with a better portfolio.
Terrific. Thanks very much. Over to you, Henry.
Great. Yeah, I just, I guess I'd say one, thanks for having me. It's been actually been a great discussion. I've learned a lot along the way, so I hope everybody else has. Look, for a couple of things I'd leave you with, and we put this in our latest piece, is just our expected returns are way down, and we hit on it. We didn't get to spend enough time on it, but the 60-40 split is to work, and so there's both a tactical element where you think about, we do things in opportunistic credit on the liquid side that I think really have generated alpha and excess return. And then there are more strategic things that you have to get right. And so I want people spending more time thinking about the benchmark they're trying to beat and then really dissecting that to come up with like, what is it? Everybody loves emerging markets, but are you really getting access to the rising GDP per capita trends? I mean, I've been traveling emerging markets since the early 90s, and I still don't believe that most of the vehicles available do that. That's point one. Point two is I do think there's a tectonic shift in the U.S.-China relationship. And I think that's important for thinking about everything from politics to national security. I mean, it used to be that technology was just national security, and now healthcare has become national security. And so that definitely influences a lot of my my thinking. And then I just, as one, in terms of asset classes, I do want to emphasize, we are tilting our balance sheet and our, some of our excess capital and what we're doing with LPs towards this idea of having yield, collateral, and some form of inflation protection. And so I think if we end up in a low rate environment, that still does well because you have the collateral and you get the cash flow. And if for some reason we have a policy mistake, you've got a little bit of a safety blanket. So there are lots of different ways to play that, but I think that hasn't been as conventional in people's thinking. And to your point earlier, you can do that. And actually, we didn't get to spend any time on this, but you can do that and then also do well for the community around you. There's a lot of stuff on infrastructure that we're finding that benefits not only our LPs, but the communities where our LPs live. And so that's been a big focus for KKR. And I think it's important we do that through our ESG fund, but I think it's important we do that through our other bigger funds where we really can move the dial on the $270 billion that we manage. So thanks for having me, and hopefully those comments were helpful.
Okay, well, thanks very much. And it's a good note to end on, just to remind us that what's important in allocating all of these funds, all of this capital, is also to help it to grow the economy and also resolve some of the issues in the local communities and help those. So thank you both very much. Henry McVey from KKR, Mohsen Fahmi from PIMCO, and this is Caroline Atkinson from RockCreek. Thanks very much indeed.